Hello, I'm Roger Peterson. Welcome to Market Call. Michael Simpson is on the show. He is the portfolio manager at NCM Investments, and we'll be taking your questions on North American Dividend Stocks. And of course, you can reach us toll-free at 1-855-326-6266 or send us an email, marketcall@bnnbloomberg.ca. All right, Michael, welcome back, I guess I should say.
Thank you.
It's been a couple of years or a few years since you were on here, but good to see you back.
And first time in the new studio, but thank you.
What do you think?
It's amazing. It's very elegant.
I like it. It's lovely, and we have windows in the office, which is always nice. Let's start off talking about I know everybody's talking about the gangbusters in the markets. It's September. There was virtually no slowdown, which you kind of can see at times. But this year there was nothing. But you're thinking that we may see a bit of a change.
Yeah, it's always hard to predict when you have a pullback. Historically, the weakest month is September. We went through September with relatively good results, as you pointed out. October is the second weakest month historically, then followed by April. But if there was a small pullback, I wouldn't be surprised, but I would take advantage of it. And also, there's also at times a two-tiered market where some of the higher valuation stocks are getting lots of love, lots of attention, and there's some stocks that are neglected. What many investors in Canada don't realize is that over the last 12 months, there's been over 30 companies that have been subject to actual or pending takeovers. So our market is cheaper than the US. And in my fund, the NCM Dividend Champions, 3 companies have been subject to takeovers: Andlauer Health, Parkland, and most recently Dental Corp. So Canada is cheap, and it's for Canadians, it's a call to invest in their home market.
And an interesting thing you mentioned that we were talking about how the market's up about 21%, but a lot of that's being driven by the metals, isn't it? Which can be precarious.
From Scotia Global Research, if you X out the performance of gold and silver, that's about 12%. So when you just take a look at the Toronto market without gold and silver, the market's up about 12.7, 12.8%. So, if you're underweight gold and silver as a portfolio manager, your performance isn't the greatest, but this doesn't always happen in the Canadian market, but there's a lot of different things happening in the world, as we know.
Okay, and let's go back to saying, do you think the TSX is a better place to be right now?
Well, we're fundamental investors. Valuation is cheaper. You get a higher dividend yield. Also, other metrics are good. We think over the next couple of years, you want to be in hard assets, and that's what Canada has a lot of. So I'm a North American manager, but new money coming in will go about 75% in Canada and 25% in the US. So that's how I see the world.
And where are you turning your focus on that right now?
Well, there are companies in Canada that are good hard asset companies that grow their cash flow, pay dividends. A company like Pembina, they have pipelines. They'll benefit from future NLG expansion. That's one of them. I have top picks. 2 of the 3 are Canadian. So Jameson Wellness, it's over 100 years old, making vitamins and mineral supplements. So there's lots of good names. Keyera, they made an acquisition in the summer of the Plains Midstream assets. So there's great companies in Canada. You don't always have to look to the US for good value.
Okay, and just one before we head to our break and then get ready to take some calls. USA Rare Earth said they've been talking to Trump and down in the States, and their prices gone up through the roof right now.
Yeah, it just shows you the demand for rare earths. The U.S. wants to make sure they have their own supply. The supply is either in the U.S. or friendly countries, which Canada is one. Rare earths go into so many things in the defense industries, electronics, so many industries and sectors of the modern economy. So it's crucial that the U.S. and Canada have access to rare earths.
Okay. On that note, we're going to head to a break, but we are going to take your calls. Coming up, we'll be back with Michael Simpson of NCM Investments for your questions on North American Dividend Stocks. Back with Michael Simpson of NCM Investments to take your questions on North American Dividend Stocks. And Michael, let's go to an email right away because I know we have quite a few calls lined up as well. This is from Toby, and can you give us your thoughts on Merck?
Yeah, so throughout the year we've seen massive sector rotation. Over the last 10 years, healthcare in the US has one of their worst performing periods over 10 years. So Merck is a global pharmaceutical company, two key drugs, Keytruda and Gardasil. They're used to fight against cancer. This is a good company. There's been more money that's gone into the pharmaceutical companies that have developed obesity drugs. So Merck is a good company. It's very cheap. It has a more than 4% dividend yield. And even if sales of Gardasil are not meeting analyst expectations, all pharmaceutical companies have a pipeline. So they're not just dependent on one new drug. They may have 8 or 10 new drugs. So as we've seen massive rotation, I don't own Merck, but it's the kind of company I would look at because of its cheapness, because it'll be around a long time. There was also some concern about tariffs. Merck is based in New Jersey, so I think there'll be very little impact vis-a-vis tariffs because they are investing in the U.S. So Merck's a quality company, and for the viewer, if he holds it, I'd continue to hold it.
And what about the industry as a whole? Is it time for some people maybe to kind of return to it a little bit, to the pharmas?
I think so, because on valuation, it's much cheaper than the overall market. In my fund, I own Johnson & Johnson. A few years ago, they spun off their consumer division, and so now they just have the drugs and medical devices, and they're traded about 14, 15 times earnings. They're also another big U.S. company that's investing billions of dollars in building new facilities in the U.S., so that gets them on the right side of the Trump administration. So absolutely, and we're seeing money starting to flow there from some of the more, let's call it, overvalued sectors.
Okay, let's move on and bring in John from London. Hi, John.
Ross, thank you, Michael. Michael, my question's on Meta. Meta, like so many in the Mag 7, tends to go up fairly steadily and then acutely, and then it'll tread sideways for a while. They've pay a small dividend, and they just made a deal with Nabias, the cloud services AI provider. How do you like Meta? Should I add to it at this point? How do you like it for the next 2 to 3 years? Thanks very much.
Okay, so Meta has done very well, formerly known as Facebook, doing very well on advertising, spending a lot of money on AI. So I would say what we have to wait and see is the return on investment in AI. I think return on investment in AI is showing dividends initially on their advertising platform. So I don't own Meta, but for a company that's going to do well over the next 3 to 5 years, the caller has an investment horizon of 2 years, but I think you should still continue to hold it.
And with AI, is this one of those groups that could there be one big winner and then the rest lose, or can they all kind of win on this? Are you feeling?
Well, it remains to be seen. So we're in the early days or early innings because we love baseball here in Toronto,
especially right now.
Exactly. So there will be winners, but we're not going to determine that for maybe 3-5 years down the road. And it's also how corporations, companies adopt AI. So we don't know yet, but we're just going to see. We're going to monitor the spending and how effective the spending is.
Okay. Let's move on. Chris from Victoria, BC.
Oh, good morning, gentlemen. I'm hoping to get the guest's opinion on Pembina Pipeline. It's picking up not as fastly as the other pipelines, but it's doing well recently, and it's a core hold for me. I'm wondering what your thoughts are for the next 5 years and what your favorite pipeline would be if you'd have one. Thank you so much. I'll hang up and listen.
Okay, thanks for the call. Pembina is a company we own. It's a large weight in the dividend champions. Pembina, they own pipelines and also midstream assets where natural gas goes through it, they clean it up, they send it out. They have good growth projects on the West Coast with potentially Cedar LNG. Their gas goes also from Western Canada down to the Chicago area. Mm-hmm. So I like Pembina a lot. It's a great company. They pay a good dividend. They grow their dividend, good balance sheet. So like John, it's one of my core holdings too.
Nice track record to follow, right?
Yes.
Okay. Chris, thanks for that. We're going to get to Glenn in Thornhill, Ontario. Glenn.
Thank you for taking my call. Michael, I believe when you were with Century, you had a position in Chemtrade Logistics. They are currently reporting record earnings, and yet the stock is well off its all-time highs, and they had some previous mismanagement problems. Yeah. What do you think about it now?
Yeah, thank you. Chemtrade is a company that I used to own. I don't own it now, but they've gone through a new CEO. He's done a really good job of restructuring. They still have the same CFO who's been with the company over 20 years. So Chemtrade is in the business of providing environmental services. They produce sulfuric acid, which goes into the oil and gas industry and fracking. They also produce water treatment chemicals. They also have chemicals that go into the food industry. So I think Chemtrade, I'm going to spend more time on it. I think it's a good company. They've reduced their debt. Some parts, or a good chunk of their business is economic sensitive. Some of their asset price is priced off a esoteric index called the Northeast Asia Spot Index for chemicals. So I like Chemtrade as a smaller cap. Some investors may be concerned that they still have the income trust structure. I've talked to management a number of years ago. They say it's too hard to remove the income trust structure. But Chemtrade is a name that I think should get more attention as they continue to do well. Their debt has come down, and we saw Warren Buffett make an interesting investment into Occidental Chemical. So that's not exactly the same, but a similar line of business that Chemtrade's in. So I like it. I like Chemtrade, and I'll be doing more work on it.
Okay. All right, on that note, we are going to take a bit of a break, but we'll be back with Michael Simpson of NCM Investments to take more of your questions on North American Dividend Stocks. All right, we are back with Michael Simpson from NCM Investments, and now we're going to get back to the phones, Michael. A lot of people want to talk to you. Elliot from Hamilton, what's your question?
Paychex reported last week an okay quarter, and yet somehow the price of its shares is steadily declining from 148 to 123. Is this fears over an economic slowdown, or maybe people are worried that AI is going to sort of supplant a lot of its human resource functions? Please, your thoughts on PAYX. Thank you.
Okay, so Paychex is in the same space as ADP. They do payroll processing. They more target the small and medium business. So even if you get small upticks in unemployment, that has some investors concerned. These are really good, steady companies, but along with that steadiness, they really attract a premium valuation. So it could be concerned that there's some weaker data. I don't own Paychex. It's a good company. It competes with ADP and others. I don't think right now you have to worry about AI so much. These provide essential services to companies. It's just the debate over whether you're going to have a growing economy or the economy is going to be shrinking.
And is that a kind of industry where you might see AI assisting as opposed to replacing?
Absolutely. AI assisting, also providing more data. And as governments look for more timely data, this is where the payroll providers can provide more up-to-date data that's not lagged, that gives people like me all sorts of important, crucial information about the economy.
Okay. Let's get back to the phones. We're going to stay in Hamilton, Ontario. And John, what's your question?
Hi. Thanks for taking the call, and welcome, Roger. Welcome back.
Thank you.
I am a dividend investor, recently retired, focusing more on income. It's hard to find Canadian stocks that are relatively cheap right now. I'm looking at GoEasy. It has dropped since September. Significantly, I guess, in my opinion, does pay a dividend. Would like your take on it being a good long-term dividend player that has income as well as some growth. Thank you.
Okay, so GoEasy provides credit loans to many Canadians. Some of them are independent entrepreneurs. They can't go to the traditional institutions for loans. GoEasy it might be, I'm not sure, about 7-8 months ago, changed their CEO. The new CEO has good credentials, but really the pressure on GoEasy is about the economy, especially the Canadian economy. Canadian economy being weaker than the U.S. economy, unemployment going up at a higher rate than the U.S. So I think GoEasy we're going to monitor the next results to see how they're faring in a more sluggish Canadian economy. But to your point, goeasy has done really well over the years, and the new CEO is going to bring in new products which should help out the company long term.
And does on a company like goeasy, when the economy is sluggish, does it help goeasy, or is it better for them or not?
Yeah, that's a good point. It really all depends on their credit underwriting. So as the economy gets more stressed, their loan losses actually may go up. So in some ways, it hurts them if you see more stress in the economy.
Okay. Let's get back to the phones. And Peter from Victoria, BC, what's your question?
My question's on Algonquin Power.
Okay.
Okay.
Yeah.
Any particular part to it, or just about Algonquin Power in general?
Algonquin Power and specifically.
Okay. All right, Peter, thank you for that call.
All right. So Algonquin Power has been around a long time, former income trust. It used to be primarily in Canada, and they've sold most of their renewable assets except for their hydro assets. So Algonquin Power has wastewater utilities in the U.S. They have some rate cases coming up, which always gets analysts a bit nervous because they don't know if the regulator will decide in their favor. They've got a new CEO. He's trying to turn things around. Debt levels are a little bit high. We don't own it. Unfortunately, under the old management, they expanded too rapidly. They had to cut their dividend in 2023 and 24. We don't own it. We watch it. We monitor it. But it'll be interesting to see also they've talking about redomiciling in the U.S. because most of their assets are in the U.S. So it's something we keep on our radar screen, but we don't own right now.
All right. What would that mean then if they redomicile down to the U.S.?
Yeah, it might have an impact where they might want to appeal more to U.S. investors. It might be cosmetic move where they have a listing on the U.S., but obviously you'd give up your Canadian head office. Mm-hmm. But it's really, do you want to appeal more to Canadian or U.S. investors? They actually might be too small to be on the U.S. market. So,
okay.
Yeah.
All right, let's head to Scarborough, which part of Toronto there, and Nizar. Nizar, how are you?
Oh, hi, Roger. Welcome. Hi, Michael.
Hi.
May I have your thoughts on Power Corporation, please? These Lifeco's operations are mostly concentrated in Canada, U.S., and Europe compared to Manulife and Sun Life's. It has had a very good run and is hitting its 52-week high at $60.40. Would you hold or trim some gains in view of the fact that we are still in cyclical correction territory in October? Thanks for taking my call.
Okay, so Power Corporation is a very solid blue chip Canadian asset manager. The caller identified the insurance operation Great-West Life. They also have asset manager with investor groups, Mackenzie, and also private equity funds holdings around the world, primarily Europe. It depends. If you're a long-term holder, I'd continue to hold. If you've made gain and want to harvest some, you could trim here. But Power does a really good job of managing their assets, paying a dividend, increasing their dividend. So if it's a core holding in your portfolio, I would continue to hold it.
All right. And do you want to buy too at this point with it?
No, I might hold back for, as the caller said, for a little holdback. But if he owns it, just continue to hold it.
Okay.
Yeah.
We're going to take another quick break. We'll be back with Michael Simpson right after this. All right, Michael hasn't been on the show in a little while, so no past picks today, but we're going to take some time to get his thoughts on the Prime Minister heading to Washington to meet with the President, Donald Trump. Sure. Another meeting, of course, we know what it's going to be discussed, trade and security. What would you like to hear come out of that meeting?
Yeah, full agenda, lots of trade items. First time Prime Minister Carney went down to Washington. It was tough, it was challenging, but he showed grace under pressure. So the same thing, advance the interests of Canadian business and Canadian workers. The U.S. needs our aluminum. Steel is a little bit different. Steel is more a global commodity, but the U.S. gets about 62% of their aluminum from Canada. So I'd like to see progress on tariffs coming down. I'd like to see maybe an idea of what's going to happen with the USMCA or Canada, US, Mexico free trade agreements next May. Just some progress and reinforce to the US that we're a friend, we're a steady ally. We can resolve any differences that the US may have vis-a-vis Canada's trade, but we're a good trading partner. Trade is for the mutual benefit of many parties. Adam Smith talked about it, David Ricardo, there's comparative advantage, relative advantage. So Canada's a good partner in a world that's getting more dangerous. It's good to have allies, and Canada's doing a good job in stepping up our military and our defense of our north. So I'd like to see some progress on the trade front and reassure small, medium business that they can still trade and sell to the U.S.
Do you have any companies, or are you following any companies that have been hit by the tariffs, and how are they doing with it?
Yeah, I mean, there's some large companies. So the poster child of that might be Canadian Pacific. For viewers, Canadian Pacific a few years ago merged with Kansas City Southern. So, you can take a rail car now from northern Alberta all the way to Mexico. So a lot of the goods now are covered under the USMCA, so which is good. But a lot of business owners, managers want to know what's going to happen next May. So that's front and center. I don't own any lumber companies right now. I have in the past, but whether you're a West Fraser or Interfor, it's really tough time in that industry, and also steel. A company like Algoma and Sault Ste. Marie, they can compete, but they can't compete with 50% tariffs. So maybe if there's some compromise there, like we need some relief for our steel industry in Canada.
Okay, and what about the defense industry here in Canada with talk of the Golden Dome and us having to up our spending in regards to what Trump has been calling for? What about that? What about that field?
Yeah, so defense industry in Canada is small. As a company I used to own in Canada, they provide more services, Calian Group. We need to spend more, so that will come from government. But there's now also a movement in the U.S., I think it's going to spill over to Canada, where smaller venture type companies work with the armed forces to say, this is our product, can you test it, will it work? And they'll even give those companies some money to see if their concept can be proven in the actual combat zone. So I think we'll see more spending, and it's also there's a symmetry that's not perfect, where you can have a drone which costs hundreds and thousands of dollars to inflict damage, but the traditional response was to use missiles, which cost millions of dollars to defend against. So you may want to defend drone attacks against drone attacks just so you're saving money and you're doing things more efficiently.
Now, you mentioned we have a small defense industry, but are there spin-off industries that would benefit from this that you have an eye on?
Yeah, you look at everything. Perhaps it's software, because I listened to one military expert. He said the next war, may be fought using software, and it could be over in 15 minutes, depending on who's the best software. So you look at software and other capabilities, because we know in the past there have been cyber attacks. So companies that have the capabilities that have good cyber protection.
And going back to the meetings tomorrow, we probably won't hear anything, or just some progress has been made. But is there something that would make you say, "Uh-oh"? What if you from the Prime Minister?
Yeah, just like I said, there's key sectors: steel, aluminum. See if there's any progress there. Are they starting to talk about the Canada, U.S., Mexico trade agreement, which expires in next May? Can we give the U.S. a bone? Can we import more goat milk rather than importing it from India? Just something that allows the U.S. to show a win for the Trump administration. Can the U.S. take more of our aluminum so they can benefit their aerospace, their defense industry? I'll be looking for that, and just some maybe relief for Canadian business, so they can restore confidence.
Okay. All right, we will be back with Michael Simpson of NCM Investments, taking your questions on North American Dividend Stocks. All right, we're back on Market Call. Michael Simpson from NCM Investments, talking all kinds of stocks with a lot of people. We got a lot of calls right now. Let's get back to them. And Val from Ottawa, how are you?
Can I get your opinion on Tourmaline? Thanks.
All right.
Sure. Tourmaline is a core holding. It's the largest natural gas producer in Canada. Most of the assets are in Western Canada. They reported that their Q2, and in my view, is fine, but they told analysts that they want to spend more money in infrastructure, which is absolutely the right thing to do for the long-term health of the company. I like this name. Right now, natural gas prices in Canada are low. We will get a winter. Hopefully, it's a little more colder, but they have the ability to sell into the U.S. market and other markets with the new LNG terminals off the west coast of Canada. So even in a low natural gas environment, Tourmaline has paid a dividend. They paid special dividends. So outstanding management. I continue to hold it, and I'm not impatient with this name.
And are we starting to see more movement, natural gas west, with that new terminal?
Absolutely. We're seeing more tankers come in. There's analysts that track the number of tankers. So this is good. This gives Canadian producers an outlet besides the United States, and the world wants our natural gas. So it's great for Western Canada.
Okay. Brent, speaking of Western Canada, from White Rock, BC.
Good morning. My question is on TELUS. Would Michael be a buyer of this stock right now, and does he consider the dividend to be safe? Thank you.
Okay. Thanks for the call. TELUS is a name we used to own. It's very, very competitive, very tough times in the telecom industry right now. We saw Bell a few months ago cut their dividend by 56%. I don't know any names right now. TELUS has a catalyst, I would say, in about 9-10 months where they spin off their healthcare division. I think the healthcare division spin out will be more successful than their TELUS International, which they took in, which some institutional investors weren't happy about. So as TELUS keeps on doing well, or as they progress in a very difficult environment vis-a-vis the competition, they are committed to growing their dividend. I'd rather see TELUS slow down their dividend growth and pay down debt, but it's a good company. They've grown their dividend for many years, but if around the $20 level, I'd be more a buyer. But if you're going to hold it for the long term, I'd continue to hold it.
And what has you worried about the debt?
The debt, just because telecoms are a mature industry, it's hard to grow. They have a vertical health where it can grow more than the telecom industry, where there's TELUS, Bell, Rogers. Mm-hmm. They're fighting for customers. With the slowdown in immigration, there's less new customers potential. So it's almost like a zero-sum game. You have to take the other competitors' customers. So in mature companies that generate cash, you have to be mindful of the balance sheet.
Okay. And just a reminder, BCE is our parent company. Okay, Joe from Montreal, what's your question?
I want to ask your guest about TD Bank. I'm a retired senior. I have TD in my cash account. I was lucky enough to pick it up mid last year at just under $79. What's his outlook for the company? Should I be taking some profits now, or should I just hold on to whatever level he thinks it's going to reach? I appreciate your advice. Thank you.
All right. Thank you, Joe.
Okay, Joe, you've done very well picking it up at 79. I think now it's 113, 14. TD, as we know, got into trouble in the U.S. with violating some AML, anti-money laundering regulations, brought in a new CEO, brought in a whole new board, whole new set of compliance professionals to make the company run smoother. Some analysts are concerned about their growth being capped in the U.S. They bought a U.S. brokerage firm, Cowen. I like TD for the amount of cash it has on its balance sheet. So if there's any weakness in the Canadian economy, they'll be able to withstand it. They also, that cash can allow them to buy back shares. So depending on the caller's time horizon, they pay dividends, they'll grow their dividends. They also got a lot of cash from selling their Schwab stakes. So I would hold on to it. Don't try to time the market. The market may be down. I'm not concerned about that. Just it's a well-run Canadian company. Their ROEs on Canadian banking are 40%, and they want to get into wealth management, or expand wealth management, which is much higher ROE. So I would continue to hold TD Bank.
Okay. And are they looking at going beyond the U.S. and Canada? I think I saw some banks in Europe when I was there. Are they looking to expand beyond North America?
They may on the asset management front, because that is you don't have to put a lot of you don't have to put a lot of assets in there, and you get higher ROE. But in terms of European banking, I don't think they've indicated to the investment community they want to expand in Europe.
Okay. Let's get over to Lloyd in Manitoba. Lloyd.
Hello.
Hello.
Yeah, my question is on Western Union, WU. It's got over an 11% dividend, and there is strong insider trading.
Okay. All right. Thank you for that, Lloyd.
Yeah. So I guess maybe Lloyd's referring to insider buying. So Western Union is the original company where, let's call it, foreign workers in the U.S. would remit money back home all over the world. The concern is always about disintermediation by new technology. So Western Union has survived. I was surprised. I thought maybe some large technology company would take it out because they have this platform. Some people complain about the prices that Western Union charges. So I haven't owned Western Union in a while, so I don't know. I haven't done a lot of work recently. So I can't give you a recommendation to buy, hold, or sell. The 11% yield is enticing, but it also could be a red flag. Vis-a-vis, you have to look at how much debt they have and whether they're covering the dividend. So I can't give you a firm buy, hold, or sell opinion on Western Union.
Okay. On that note, we're going to take another break, but we will be back with Michael Simpson of NCM Investments, taking your questions on North American Dividend Stocks. Michael Simpson from NCM Investments is with us, and on the phone is Dave from St. Catharines, Ontario. Dave, what's your question?
Hi, thank you for taking my call. Michael, I'd like to ask you about Royal Bank. I believe the dividend is safe and they increase it every year, but could you tell me how much growth you would expect in the next year or so? Thank you very much. Have a great day. Bye-bye.
All right, cheers. Thanks, Dave.
Okay, thank you. So Royal Bank is a company we own. As the caller mentioned, they do increase their dividend every year. So they're very strong in Canada. They get a premium valuation for a good reason, good management, a global wealth management franchise, Canada, US, the UK, also big trading platforms in Canada, the US, good investment banking department. How much they increase their dividend every year, depends on the earnings and cash flow. As capital markets pick up, as we see more IPOs, more so in the US and Canada, you have a good chance for predictable dividend increases. We like Royal. It's not as cheap as it used to be, but we continue to hold it because it's a well-run, solid pillar of the Canadian economy.
Yeah, are the banks a pretty safe spot?
They are. It's, as one analyst told me, they're a leveraged play on the Canadian economy. So we have to see, the great mortgage reset. If the banks did their homework and if some of the riskier credits went to the alternative lenders, they should be okay. But we just have to see how the Canadian economy progresses over the next 12 months.
Okay. All right, let's get to Chad in Saskatoon. Chad.
Good morning to you both.
Good morning.
Michael, I have a question. I'm looking at your opinion for MDA Space. With the pullback after they lost the contract to EchoStar, it dropped a lot. At that time I got in, I started a position. From what I understand, they do have a significant amount of contracts and backlog contracts. Still, I was just wondering what your opinion is to go forward. Thank you. I'll hang up and listen.
All right. Thanks, Chad.
Yeah, MDA Space is a company I don't own, but as the caller said, after that drop, I'm doing more work. It's a great Canadian company. They do have a great order backlog. The contract was canceled as their customer sold their spectrum to Elon Musk's company, Starlink. I like this company. I think it'll continue to grow with the amount of money going into low Earth orbit satellites, the amount going into defense vis-a-vis satellites. So I think it's a great Canadian company. I think it's a good time to pick it up right now.
And especially, I imagine, with everything that's happening with AI, this is playing right into it.
Absolutely. They're satellite images, and it's a good way to play AI through the space.
Okay. Jeff from Huntsville, what's your question for us?
Yeah, I'd just like to know your guys' thoughts on TC Energy. I've had it for a while, and it's had quite the run. I'd just like to have his thoughts going forward to hold or maybe take some profits. Thanks.
Okay.
I'll hang up and listen.
All right, awesome. Thanks, Jeff.
Yeah, so TC Energy is the former, I think TC Energy, but they spun off a division called SOBO, or South Bow Valley Pipeline, which primarily takes heavy oil from Edmonton down to the southern U.S. TC Energy is a great Canadian company, pays dividends, grows their dividends. It depends what you're using, or depends what your purpose is or investment time horizon for TC Energy. It pays a dividend, grows a dividend. The amount of, we're talking about AI and data centers, so more data centers need more energy. A lot will be fueled by natural gas, so that's right in TC Energy's wheelhouse. So if this is a core holding for you, I'd continue to hold it. There'll always be pullbacks, but you could use the pullbacks to add more, but you're getting a nice dividend, you're getting dividend increases, so and you're probably getting one or two rate cuts from the Bank of Canada, so that should help these utility and pipeline stocks as well.
Okay. All right, let's get into some emails right now, Michael. First up, an email from Andrea. She says, your guest mentioned Kira at the beginning of the show. I've been holding this company for 5 years. My average price is 25. Where do you see it going?
Well, the caller's done very well, so I see Kira going further ahead. I bought some of the Kira on their recent issue when they issued subscription receipts to buy the Plains Midstream Canadian assets. I like Kira. They pay attention to their balance sheet. They grow their cash flows. Some analysts are concerned about the percent of revenue they get from their marketing business. But with the Plains acquisition, they have that marketing exposure hedged. Very solid management, good growth opportunities. I like it. I would continue to hold it. No problem buying it here.
Okay. And we'll move on now to Tyler and K-Bro, another email.
K-Bro, yeah.
Fun to say.
K-Bro is a name from the past. K-Bro does in the business of dirty laundry, but now they're actually laundry. So started out all in Canada, 2 segments servicing the healthcare and hospitality. I don't own healthcare. It's a little small, but there was some stock that came available. I would surely buy it. A few years ago, they expanded into the United Kingdom. They got a little bit hurt by COVID when hotels were seeing much less volume. It's a good company, good growth prospects ahead. I like it as we see more money being spent on healthcare, as they win more contracts because they're one of the most efficient laundry providers in Canada. I think they're a good company. So the management is very strong. I like it, don't own it, but I've owned it in the past.
Is this one of those industries that kind of people can overlook sometimes? But you don't think linens. It doesn't really cross your mind.
Yeah, absolutely. There's some bigger players in the U.S., but they often wonder, well, take for granted, how does that towel get cleaned and sanitized in the hotel? And as we know, in healthcare, hospitals, it's very important to make sure you have sanitized, linens, because you don't want any infectious disease to spread. So they provide an essential service, and they've expanded, so that's good. So it does get overlooked because because of its size, but they have long-term contracts with hospitals, usually 7 to 10 years. So it's a little gem in the Canadian market.
Okay, and we'll get one more email before we go to break.
Thank you.
And that is from Pat, and it's, did I lose out on INTC? Was watching it at around 20 plus, now much higher.
Well, not really, Pat, because the U.S. is concerned about semiconductors and chips, and you, along with the U.S., you have a new shareholder in the U.S. government. According to Bloomberg, they own about 5.8% of the company. So as the U.S. wants to make sure that chips are made in the U.S. and they always have a reliable supply, Intel has brought in a new CEO. It's true they don't have the best chips, the most powerful new AI chips. That belongs to NVIDIA, but it depends on your horizon, and it depends if you believe that the new CEO of Intel can turn it around. So the U.S. government investment has ensured that the company will survive and has ample backers, but it all depends. So Intel has to execute now, but NVIDIA is actually has a pullback. So if you think NVIDIA can keep up their growth rate, it may also be a company to look at as well.
Okay. All right, Michael. That's all the time we have now for calls for today, but don't go away. Michael's going to share his top picks when we come back. Join us Monday on Market Call. Rebecca Telcher will be on the show. She is portfolio manager at New Haven Asset Management, and we'll be taking your questions on Canadian dividend stocks. And if you missed Market Call, check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for Michael Simpson's top picks that he wants us to take a look at. And I think there's a little bit of something for everyone here, isn't there?
Yeah, I think so.
It's quite the mix. We'll start off. We're going to go flying, hit the skies. Cargojet.
Yeah, so Cargojet is air cargo company. I've known the company for over 20 years. Solid management. They've got 90% market share of the air cargo company in Canada. Over the last 5 years, they've doubled their revenue. EBITDA has increased by about $200 million. They have good customers like Amazon, DHL, Andlauer Health, Canpar. They serve 16 Canadian cities. They also do international charters just to bring in more money. Analysts are concerned the volume isn't as high as it used to be, but they're still making money. They're utilizing the planes correctly. When volume picks up, they won't have to buy new planes or go through a new CapEx cycle. Debt has come down about 2.5 turns of debt to EBITDA. I like this. It's very cheap, and we've got 2 new analysts bringing coverage of it. So it's a good Canadian company, and I think it'll continue to deliver good results, and it should get more attention.
Now, you mentioned the volume was down a little bit. Also, I mean, they have, I think it's 90% of the market.
Yes.
Any concerns that it's hard to grow that?
No, because they are continue to expand their relationship with DHL, Amazon. They do some international charters. Sometimes they do charters for United Nations agencies where they're dropping off food. They do an international charter between Toronto or Hamilton, their base in Hong Kong. So they have the ability to grow their business. Not worried about that at all.
Okay. Anything you'd like to see them do or see them be doing differently?
No, they've got simulators. They've, in the past, they may have pre-ordered based on volume that was maybe not all there, but I think they're running it well. So no complaints about management. I think they're doing a good job. It's just become an underloved Canadian stock. So I'm here to give them some love.
Now, isn't the airline industry one of those ones where how do you make $1 million? You invest $10 million, but these guys seem to be doing it right.
Yeah, that was the old Warren Buffett saying, but they're in cargo. And when you've got 90% market share and you're the leader in it, have no complaints. They train their pilots on simulator they have in Hamilton. So,
okay.
Yeah.
All right, let's move on to Jameson. I want to say meds, but not pills either. The name is eluding me. Yeah. Vitamins, thank you. Somebody came in my ear there and said vitamins.
Vitamins, protein
vitamins, protein.
We're going to try and pump up portfolios across Canada. So Jameson Wellness, iconic Canadian company we talked about, over 100 years old, founded in Windsor. They bought a company a few years ago, U-Theory in California. So very little or no impact from tariffs. They're also growing in China. Now, some people say that's a concern, but I know Chinese consumers are very careful about what goes in their body vis-a-vis vitamins and minerals. Great Canadian company. I take their iron vegan protein powder. So we've seen takeouts of private vitamin and mineral companies at much higher valuations. They've grown their dividend over the last 5 years at about a 14% clip. So it's a great company, and I want to make sure it stays in Canada and grows.
Okay, and with China, with that market, do they look at the Canadian goods as being solid and reliable?
Absolutely. They look at the Jameson label, the purity label. Jameson management has told me, like, anyone can do what we're doing, but they pay so much attention to the process and purity. So that's what makes Jameson stand apart from their competitors.
All right, we're almost out of time. I talked a little too much, but Lincoln Electric, let's get to that quickly.
Sure. So the very boring old economy industry of welding, it's a play on robotics, automated factories coming back to the U.S. Also AI, those robotics can be powered by AI to make used in heavy industries, autos, shipbuilding. Lincoln, great return on invested capital, ROE, pay a dividend, grow their dividend. So it's just a solid company. The U.S. economy accelerates. 50% of their revenue comes from what's known as consumables in the welding industry. So just a very solid, under-the-radar company.
So there's always demand for it.
Absolutely.
And not something that's going to be easily replaced?
No, they're the leader in the field, and you use welding equipment, you have to replenish your supplies, et cetera, et cetera.
Okay. Michael, thank you very much for joining us.
Thank you, Roger. It's great to be back.
All right, and we'll have you back. So
Thank you.
we'll have your past picks. We'll take a look at these ones in a few months.
And go Blue Jays.
All right, thank you, Michael. Michael Simpson is from NCM Investments. Thank you very much for watching Market Call. We'll see you next time on Market Call.